How to avoid losing money in crypto. Crypto trading nowadays is a big chance to make money for everyone. Sign-ups at crypto brokers are easy and fast, and sometimes there is not even an ID verification needed. When having filled in an email and password, the user just needs to click the link in the email confirmation mail he gets right away. Then he's ready to make the first deposit. If it's a Bitcoin or other crypto deposit, this step is again super fast. Then the fun begins, setting orders and playing the game. But crypto trading is not just about knowing how to set an order, getting a coin and waiting for the great profits crypto got famous for in the field of trading. You must have certain skills, a precise plan how to react on certain changes in price. Like when price simply turns around, against your position. There we come to the first and most crucial way to avoid losing money in crypto. When is it used? Unlike a limit order, which aims to profit from the current trends, a cryptocurrency trader will use a stop-loss order to limit potential losses to no more than they are able to take on. This is not only a step towards maximizing profits. It also expands the trader's options for strategizing, by increasing their control of the trade's risk factor. For stop-loss to be used effectively, the trader still needs to predict how the market will behave and tailor the stop-loss accordingly. Otherwise, it may not only fail to prevent loss but also multiply it. Once the trader has an idea of how the market will behave, they must choose both the value and type of stop-loss order they wish to use. Stop-loss types. Full. Liquidates all crypto assets when triggered. This is useful in a stable market with sudden unexpected price fluctuations, so that any price drop is predicted to remain low. While a surge backup will mean the trader loses out on potential profit, they will have avoided a loss if the price of crypto remains low. Therefore, when setting a full stop-loss, the trader must consider the risk and reward of both scenarios. Partial. Liquidates a specified proportion of the digital assets when triggered. This can be useful in a highly volatile market, i.e. cryptocurrency market, to ensure the trader still has some assets remaining if the price drops before a surge. However, it leaves the trader with potentially unwanted assets, and if the price stays at a low level they will remain at a loss. This can be effective as an instrument of damage control in a highly volatile market. But it can't guarantee the safety of the trader's assets. It must therefore be used with the full understanding that the risks remain to be high. Trailing stop-loss. The stop-loss value will adjust according to the crypto asset's price fluctuations. The trader sets a trailing distance, which is the difference between the current asset price and the stop-loss value. If the price of the cryptocurrency rises, the stop-loss value will rise with it. When the price drops, the stop-loss value will not change and a stop-loss order will be triggered if the stated value is reached. This has an advantage over set stop-loss orders since it allows the trader to cap the maximum loss regardless of how far the trends have gone in their favor. What's more, this frees the trader from having to manually adjust stop-loss in response to the market. Trailing stop-loss may become a liability in a steadily rising market, as strong rising trends often drop before continuing to grow. A low trailing distance could therefore result in the assets being liquidated before the price has reached its upper limit. Risks. If full stop-loss orders are set too high, the trader risks losing out on a price surge beyond the stop-loss value. This is highly likely in a volatile market. The trader risks losing out if the stop-loss value is too low so the price drop doesn't trigger it, but then hits a steady trend after dropping. If the stop-loss is triggered, the trader will lose more with a low stop-loss value than with a high one. Although it may have been a better choice if the trader believed the market would go back up after a drop that didn't trigger stop-loss. While seemingly safer in a stable market, trailing stop-loss is a potential liability in strong upward trends. Partial stop-loss is of little use in a stable market but can be of great help when trading with highly volatile new coins. That said, all risk comes with poor choices regarding the type and value of stop-loss due to incorrect market analysis. Much like any trading tool that can be damaging if not used properly. Newbie tactic? Some believe that stop-loss is a tool used primarily, and ineffectively, by inexperienced traders. A belief that has some truth. Stop-loss can indeed be misleading for new traders since it's sometimes seen as a fail-safe rather than the complex and carefully planned insurance policy it should be when used appropriately. Yet in the hands of an experienced trader who's good at market analysis, stop-loss can be an invaluable tool that saves both time and money. Using it randomly, however, without understanding the purpose and application of each type of stop-loss will cause damage. That said, inexperienced traders working within their depth in stable markets can make just as much use out of it. So long as they stick to strategies they understand well and manage their assets wisely. It comes as no surprise that trading in a highly volatile market is more difficult and has a lower success rates than trading with relatively stable coins. Attempts at damage control through stop loss, partial in this case, will be more difficult and less successful. But this is no reason not to try it if a trader is confident in their abilities. Care about proper risk management. What new traders often don't know is that a stop loss is not just an optional order type which experienced traders use from time to time. It's obligatory for each trade from a professional point of view. Professional traders use a stop loss in every trade, as a clear decision about the loss they are willing to take is as important as their plan where to take profit. Don't chase the price. Newbies tend to buy a coin when they see a rising price on a chart. That's the typical behavior of the unprofessional crowd, getting fear of missing out when they see an ascending price. The expectation in crypto is mostly that price could still go X times higher from the entry point. But often it happens that the buy level of the newbie unfortunately was short before the peak, after which price will just go down again for a long time. Limit the money you put in single trades. One of the biggest mistakes novice traders make is putting too much money in a single trade. Since each trade always includes a risk, it's simply a numbers game how much of your whole capital you should risk each time. Too much capital in single trades can lead to a massive reduction of the whole trading capital in short time. But that's what often happens to beginners. Professional traders don't do that. Traders shouldn't take more than a few percentages of their whole trading capital for a single trade. So if you take 5% of your whole trading capital and the risk of this single trade would be 10%, meaning you put your stop loss at 10% below your entry, then it would be a 0.5% loss for your whole trading capital. Tell that to a Forex or stocks trader. Just imagine you could catch a couple of such pumps and would be able to take profits from 100% to maybe even 500%. Your whole trading capital would be doubled fast, even while sometimes being stopped out with the small losses as described. Don't use leverage. Trading with leverage, borrowed money which you have to pay back including fees, is a highly risky tool, and should exclusively be used by professional traders with years of experience. For people with little trading experience, margin trading is really just like gambling. Before you do that, you might have more fun playing a slot machine which at least offers some fancy graphics and sounds while it is swallowing your money. Treat trading as a business, which it is. You must be aware that each business has both returns and expenses. The challenge is to cut losses short and try to keep the returns significantly higher over time. A business requires that you keep track of all profits and costs, so that's what you need to do in trading as well. Accounting buys, sells, profits and losses in a trading journal that always shows you at a glance where you stand. Conclusion. While stop loss is designed to minimize damage caused by trend fluctuations, it does include some loss of assets and could end up being a waste of money. When choosing stop loss, crypto traders must consider the risk-reward ratio, as well as the importance of the traded asset to their portfolio. They should also be able to predict the general behavior of the market. Ultimately, stop loss is just a tool, and the choice to use it is based on the trader's analysis of the market. Stop loss success depends on how well that analysis is carried out. We hope you enjoyed the video. Tell us what you think about the video in the comments section below. Also, make sure to subscribe to our channel and click the bell button to get updates when we post new videos. Thank you for watching.